Right, people, how are you? I hope you are doing fine wherever you are. I am the ACCA tutor, Mr. Jerry Tunkulu. Welcome to this video where we'll be talking about cash management models. There are two models we are going to be tested upon in this examination. Okay, one of the models is the Baumol model, and the other is the Miller or model. So we are going to look starting with the Baumol model. All right, this one is not usually tested, but it is still in the syllabus. So you need to master the concepts. Now, in short, this model is of the same orientation with the EOQ model. Okay, the Baumol is just like the EOQ model. All right, so if you know the EOQ, then you are home and dry. You are just as fine. You just have to use the same concepts as we used in the EOQ. All right, and the best part of it is that the formula is given in the examination. Oh, let me take this code. So, ladies and gentlemen, the best way to master the Baumol model is to go through an example. All right, so let us go there. Okay, ladies and gentlemen, this is the example we need to do. However, let me just lay out the formula we need to be accustomed to. Like I said, it is almost like the EOQ formula, but it's essential that I outline the formula on the board. So we are saying the economic quantity of cash. All right, economic quantity of cash is given by the big square root. Okay, square root of 2 multiplied by annual demand for cash, or the annual cash required. Annual cash required. Okay, multiplied by the cost of ordering cash. Cost of ordering. Cost of ordering cash, all divided by the cost of holding the cash, or let me just say the net interest, of the net interest cost of holding cash. And I'm sure you still remember the EOQ formula. The EOQ formula, this one is given in the examination. We remember we said EOQ is given by the big square root 2 multiplied by COD over H, or CH, right? Over CH, the cost of holding stock. So it's almost just the same thing we are talking about. All right, now let's try to determine the figures from the question so that we know when to use them and when not to use them. So the question is saying, if the company sells 150,000 of investments each time, calculate the total cost per annum to the company. So here, you are not required to use the formula, right? you can do the computation on your own. Why? Because you are told of the order size. Okay, the size of the order here is given in the question, so there's no need to compute the. Remember, the EOQ is the economic order size, or the quantity which minimizes the cost of inventory, or those things, right? So here we are given the size now, or the batch size, 150,000. Okay, so the examiner has done that working already, but he is now saying compute the costs, the annual costs to the company if we are selling at the order size of $150,000. So if we are selling investments at $150,000 each time, what would be the total cost to the company? Remember, we are being told that we need 1.5 million next year. All right. But we have investments. All right. So if we're having investments, we can sell those investments, okay, and get the cash we need. So we are being told if we are selling these investments, we need 1.5 million in total, but we are selling the investments in phases, and the sizes for each phase is $150,000. What would be the total cost to the company? Bear in mind, we are doing cash management. All right. So let's do the computation. The first working is the part A, the cost of ordering. Cost of ordering cash. We are told that we need 1.5 million. Okay, but the size, the order size, or we are only going to sell the investments at $150,000. Okay, so this actually tells us how many orders are we going to make. This fraction is going to tell us how many orders are we going to make in a year. So you can see that we are looking at 10 orders, isn't it? Yes, 10 orders. All right, but we are told in the question that each time when we sell an investment, we are going to be charged $150 per transaction. So here there's 10 transactions multiplied by $150. 150, 150. So this comes to $1.5. Okay, in a year we are going to be charged $1.5 as ordering cost. All right, now let's move on to the holding costs. And like I said, the holding costs are the net interest cost. Remember this wording, the net interest cost of holding cash. Excuse me. So let's start with the interest on investments, right? Interest on investments. These investments were earning an interest of about 9%, 9.5% per year. So if we are going to sell them, then we are going to incur what is called opportunity cost. The investments were earning some return wherever they were. Maybe they were shares, or they were anything, any other thing which could be put on the market. So they were fetching 9.5% return every year. Okay, So if we sell them, we are going to lose this and it will be our cost. It is going to increase the cost. Okay, so we're going to say 9.5%, okay, multiplied by the investments which have been sold, okay, the investments which are going to be sold. In this case, we are having the 150,000 each time we are going to sell an investment plus the total amount, which was 1.5 million. All right, and we need the average of these two figures. And the reason why I am averaging, remember when we were using the EOQ, holding costs were determined to be the average. Please revisit that subject area on EOQ. I think it was in week 2. Okay, in week 2, we talked of working capital management inventories and we talked about averaging. The holding cost of inventory is actually the average figure. All right, so this is why we are averaging here. We are not just we are not reinventing the wheel. It's something which has already been done and covered. And like I said, this formula or this model follows the principles of the EOQ. All right. So what is the figure we get here? 9.5% multiplied by 150,000 plus 1.5 million or over 2. I think it is gonna give us 78375. You can check with your calculators if that figure is correct. Okay, so that is an opportunity cost. It's a relevant cost, remember. We lost that one. The moment we sold the investments, we lost this return. However, the moment we receive the monies from the investments, we are going to deposit them in the bank and we earn daily interest income. So that one is going to reduce our cost. So this is why the formula is saying net interest cost. Remember, we said it is net interest cost. Remember this formula, okay? The net interest cost. So to get the net, we say the income minus the cost, something like that, right? So here, these interests are moving in different directions. So interest on deposit now. Interest on deposit. Why? Because the moment we sell the investments, we are going to lose the investment income, but at the same time, we are going to get income from the bank because we do not keep the money in our safes. Okay, we do not keep the money idle in our homes. We take the money and deposit it into the bank, and the moment we put it in the bank, it starts to earn deposit income. Is that clear, ladies and gentlemen? Yes, please flow with me. Okay, so the interest income was how much there? All right, it was earning 5% on current account. All right, that's good. So 5%. All right, multiplied by here we only consider the 150,000, but it is also going to be divided by 2. Okay. 150,000 divided by 2 All right. And we get that will be negative 3750. Right. The reason why I'm saying negative, this is because these first two figures are costs. This one is a cost. This one is a cost. But this one is income. Okay? Is income. This is why I put it in a negative sense there. All right. So let us add up these figures. Obviously, we should arrive at 76,125. That's the Baumol for you. All right. I mean, those are the computations which are necessary for you to do computations related to the Baumol model. All right. Let's do part B. So remember, this was the total cost. Total cost as required on part A. Part B, what is the optimal economic quantity of cash to transfer each time in order to minimize costs? So here now we can safely use the E or Q. Okay, the E or Q. And the formula, we now know it. The formula is 2 multiplied by the annual demand for cash. Annual cash requirement is 1.5 million. Okay, 1.5 million, right? Multiplied by the cost of placing an order, which was $150 per transaction. Each time we make a transaction, we pay $150. So that is it, and we divide this whole figure by the net interest cost. So we remember when we said net, we are saying income minus cost or cost minus income, whichever way. So there was 9.5%, which was 0.095 minus the 5% from the bank, which was 0.05. Okay. And if you solve this expression, mathematically that's called an expression. If you solve the expression, then you are going to get $100,000 each time. So that's the economic order size each time. So you can then, if you are pedantic, you can do the computation to see if instead of using the 150 here, the order size of 150,000, how much would be the cost if we are using the 100,000 order size to prove if that is going to be an EOQ. If it is an EOQ, then it means the total cost should be lesser than 76,125, which we computed above. So let us prove. I think that is the requirement for part C. Part C is saying at the EOQ, what is the total cost per annum to the company? So at this EOQ, let us prove or be disproved. So we are saying ordering costs at the EOQ. Okay. Remember the total amount required is 1.5 million over 100,000, which is now the EOQ. All right, and each time we pay $150. So here the dollar per annum, which is the cost per annum, should come to 2,250. Okay. Please note that as the order size reduces, the number of orders increases, and that will increase the ordering cost. So if you check, just have a quick check, you can see that this amount 2,250 is higher than this amount when the order size was higher at 150. It means the number of orders was reduced. Here the number of orders was how much? Was 10. But when we reduce the order size, you will discover that the orders now are 15 altogether. If you do your division, you could see that we are left with 15 orders. So they've increased. Why? Because the order size has reduced. That will impact negatively on the ordering costs, which will increase eventually. All right. Okay, but it doesn't mean that the holding costs are also going to increase. Let us see. So we're now coming to the holding costs. All right. Let's start with the interest lost on investment. Interest lost on investments. Okay, the interest lost on investments. Okay, so remember we said we start with the order size, okay, the 100,000 plus the 1.5 million, or divided by 2 multiplied by 9.5%. Let me use the calculator here. So 100,000 plus 1.5 million it comes to 1.6 million divided by 2. 800,000 multiplied, someone is multiplied by 0.95. 76,000. So it comes to 76,000. Okay, 76,000. Then interest to be earned from on bank deposits, because we are going to deposit the money. So interest earned from bank deposits. Okay, here we are only going to use the 100,000 only. So divided by 2 multiplied by 5%. So here we are going to have 50,000 multiplied by 5%. That is going to take us to 2.5 dollars, $2.5 thousand. Okay. So if we add up these figures, 2.250 plus 76,000 minus 2.5 thousand, that gives us 75,750, which becomes the total cost. So you can safely see that we have been proven correct that this amount is lesser than this one. 76,000. Is that clear, ladies and gentlemen? So at the EOQ, we are likely to save some costs. Great. Now, let's talk of the Miller-O model. The Miller-O model does manage to achieve a reasonable degree of realism without being too elaborate. In practice, cash flows are likely to fluctuate considerably from day to day. There is also a likelihood that the balances are likely to wander upwards or downwards over a period. The Miller-O model fixes limits on the upper and lower levels. So it's going to be some limits. Okay, the basic steps involved in the Miller-O model. A surface level or lower limit of cash is decided upon. A statistical calculation is made based on the variations of the cash flows in order to agree an allowable range of fluctuations. Using this calculated range, an upper limit of cash is fixed. The cash balance is managed to ensure that the balance is always kept between the upper and lower limits. So the diagram you are seeing there can illustrate this concept further. So the y-axis is showing us the cash balance, whereas this is the time. Okay, so we're having this point A, point B. The point A is actually the upper limit, as you are seeing there, and point B is the lower limit, right? So if, okay, this graph here, this is the movement of cash movements, right? These are the cash movements, right? And this is the normal point, okay? The idle point, or the let me just say the return point. Okay, that's the level which we expect at any given time. That should, our cash balances should be within that range. However, that is not practical. Sometimes we have a lot of cash. So if we have a lot of cash, we then have to monitor that. If it reaches this point A, it means it becomes too much, right? It is now excessive. So what we do, we then have to buy securities. Okay, we buy investments. We invest. We buy investments or buy securities. All right. Then, when we buy securities, it might become difficult again to maintain the normal level. This is why you see that the cash declines to a point like B, which is the lower limit. But we do not allow that to proceed down further. Okay, we don't want that. We don't want that situation. So immediately when the cash level reaches point B, we take necessary steps. What do? We sell securities, like in the previous example. We sell the investments so that we get some money, right? Then we get the money to ensure that we come back to the safe zone, which is the return point, and try to manage our cash balances along that. Okay, so when we get more money, all right, like when it reaches point A, we then have to buy investments to reduce the amount of money we are holding, but at the same time investing it in other income accruing investments. All right, but that will mean that in the short term our cash flows will decline to the normal return point. However, like I said, it's difficult to maintain the cash on the normal point. Sometimes it then goes down, okay, to point B. So when we are now at point B, we then have to sell those investments so that we get the money back, so that we return to the return point. That's the idea. All right. So the bigger question to ask is, what will happen if there is no attempt to manage cash balances? Clearly, the cash balance is likely to meander. As I have shown you, okay, the graph is not level like this. It meanders. Sometimes it rises, sometimes it falls, sometimes it, that's how it moves. The Miller-Or model imposes limits to this meandering. If the cash balance reaches an upper limit, point A, the firm buys sufficient securities to retain the cash balance to a normal level called the return point. When the cash balance reaches a lower limit, point B, the firm sells securities to bring the balance back to the return point. That's the idea, right? How do you set the upper and lower limits? How are the upper and lower limits and the return point set? Miller and O showed that the answer to this question depends on the variance of cash flows, transaction costs, and interest rates. Right? Variance. This one has to do with some standard deviation, okay, or the sigma. Sometimes you are given the standard deviation, and what you need to do is to square that deviation, and it comes back to the variance, other things. So if the day-to-day variability of cash flows is high, or the transaction cost is, in buying or selling securities is high, then wider limits should be set. If interest rates are high, the limits should be closer together. To keep the interest costs of holding cash down, the return point is set at 1/3 of the distance or spread between the lower and the upper limit. Okay, there is a formula I'll show you. So we are being told that this is the spread, okay, the distance between the upper and the lower limit. That's the spread. Sometimes it comes in the multiple choice questions, and you guys are going to be found wondering. Okay, do not be caught unprepared. So there is a formula we need to be used to. The return point is equal to lower limit plus a third multiplied by spread, and the spread itself is given by that formula. These are given in the examination. No need to crave. Do not crave the formulae. Okay, now do this example. You can pause the video using the formulas I've given you. Please do this example alone. Okay, guys, thank you for attempting the question on your own. So let us now do the revision together. Okay, the first thing you need to do is to come up with that diagram at the back of your mind. You need to understand what is going on. So let us just do a sketch of that graph. Okay, and we agreed that this was the cash balance, and this was the time. All right, and we told each other that there was a point called lower limit, the lower limit, and there was the normal, which we said a return point, and then there was upper limit. So here we are given point the 8,000, which was the lower limit from the question. We are given the lower limit. Now, if we are having the lower limit, how do we know the upper limit? The upper limit is only found by using the spread, because we were told that the distance between the upper and lower limit, that's the spread. So the first thing we need to do is to find out if in the question the spread was given, and I can safely see that the spread needs needs to be calculated. So let's compute the spread using the formula we were supplied by the examiner. Okay, so the first thing, let's compute the spread. Spread is equal to 3. The formula is given to you. Do not worry about cramming this. Okay, 3 multiplied by 3/4 multiplied by transaction cost. Okay, multiplied by the variance of cash flows. The variance of cash flows, right? This one only, divided by interest rate. Please follow the formula properly, because if you make an error, the answer becomes wrong. Or to the power third. Okay, so we then come here and say 3, big bracket, 3/4, multiplied by the transaction cost. We are told that the cost for buying or selling securities is 50. So you slot in that figure first, $50. Okay, you can just ignore these signs for now, the dollar sign for now. Multiplied by the variance of cash flows. This is the daily variance. All right, I'll tell you if you're given the yearly variance. I'll tell you what to do. So the daily variance was 4 million. So 4 million. This figure divided by the interest rate in the question. What was the interest rate? Interest rate per day was 0.025%. Okay, that was per day. All right, and you need to put that one into decimal for ease of computation. It was 0.025%, so this one in decimal becomes 0.00025. Okay, so there are 3 zeros after the decimal. 25, or to the power third. So this comes to 3 multiplied by 6 multiplied by 10 to the power 11 multiplied by a third. So in Excel, it's even easier. Not worry. And this comes to 3 multiplied by 8.434.33, okay, which is approximately 25,303. You can further say this is equal to 25,300. That's the spread. And then to compute the upper limit, it becomes easier, because the upper limit would be the lower limit plus the spread. Okay. Upper limit, let me just demarcate here. So upper limit is equal to lower plus spread. The lower, from the question, from the diagram there, the lower, we determined it to be 8,000, isn't it? The lower limit was 8,000. So that's 8,000 plus the spread of 25,300. This comes to 33,300. What about the return point now? Okay, the return point. The return point is given by lower limit plus 1/3 multiplied by spread. Okay, return point. We said it is given by lower limit, which was 8,000. Okay, 8,000 plus 1/3 multiplied by spread. The spread is this one, the 25,300. So solving that, it comes to 1/3 of 25,300 plus 8,000. This comes to 16,400 approximately. 16,400. Now, with all this information, what is your decision now? What is the decision we should make? What is the decision we should make? Okay, now we need to get back again to the diagram. We now have all the figures we need. All right, the upper limit has been determined to be 33,300. So this is 33,300. And the return point is 16,400. The return point 16,400. Okay, now we know the principle. If cash reaches this point, we need to what? To sell. Okay, here we sell investment. We buy. We buy investments or buy securities. Okay, isn't it so? Let me just refer back. Yes, we buy here. We buy securities. So we buy investments, all right? And we buy by how much? All right, do we use the full 33,300? If we use everything, okay, we'll run out of cash, all right? So we need to use a certain amount. And what is that amount? Can somebody guess? We need to buy only an amount that will leave us a change back to this point, to 16,400. So we need the difference. So when cash reaches upper limit of 33,300, we buy securities of the difference there, that's 33,300 minus 16,400, which is the return point, and the difference there is 16,000. So we buy securities of 16,900, and need to show this working to the examiner. Okay, now what about when cash reaches this point? If our cash reaches this point, the lower limit of 8,000, what do we do? When cash reaches lower limit of 8,000, we sell now. This time we sell investments. I no longer have space there. We sell investments of how much? We sell investments of $16,400 minus 8,000. Why? Because we want the difference between the return point and lower point and lower limit. So that's 8,400. So we need to sell investments of 8,400. Why? Because the moment we sell them, we come back to this amount. We need to always wait. So we are playing our cards to ensure that we return to the return point or to the normal point. That's the idea. Okay, that's the idea of the Miller-O model. All right. Now, sometimes in the examination, you may be given the yearly variance instead of the daily variance. So in that case, you need to divide that variance by 365 days. You divide by 365 days in a year to get the daily variance. Okay, I think, guys, I've done justice to these two models, and you are now happy to attempt this topic with confidence. All right, there are a lot of notes which you guys have been given. Please read through all the notes, because the assignment, the weekly assignment I give you, is related to those notes. Until next time, guys, please continue to feel excited. I mean, very, very excited. I am signing out. Bye.